All right, our next guest says this week's market rally is built on the flawed assumption that we will have a decisive winner within the next few days. Julian Emanuel is BTIG's chief equity and derivatives strategist. Julian, great to have you with us. And you're saying that the base case scenario, in your view, is much longer than just a few days. I mean, you're talking weeks and maybe months here.
Melissa, I think we've got a volume problem on your end.
Oh, can you hear me now, Julian?
Yeah, I got you.
Oh, okay, great. So as I was saying, your base case scenario is beyond a couple of days. It's more like weeks or maybe a month.
Got no volume.
Okay, we're going to try and iron that out. Julian Emanuel, we'll get to you when we get to you, hopefully, when we get the volume. But basically, his base case scenario is more like Thanksgiving or even January. And what sort of market uncertainty that would cause, Karen? I mean, that would seem like that would be chaos. It would be way beyond Tom Lee's up 5 to 7% in a contested election scenario.
Yeah, I think so. And I think we would start to see some unrest maybe in that scenario, in which case you could see that having, curfews and then having some kind of dampening effect on the economy. I think also just people are exhausted. They just want this thing to be over already. I think that to me is a bad case scenario. I don't think we'll end up there, but if I knew that for sure, then I'd be buying puts even at this vol.
Yeah, Bonawyn, how about you?
Yeah, I mean, I think the more protracted and disputed this thing is, as Karen pointed out, I think that's really the downside event that the market isn't accounting for. Yes, VIX is still at 35, but I think you'll probably see VIX up around the 45, 50 level if we were to have an election that was disputed out until the holidays. With that said, I do think the market is getting a bit more comfortable with either scenario, right? What I think is first and foremost is pandemic and the economy, how we attack that. And I think the other things are secondary and tertiary in terms of their level of importance.
Yeah. I think Julian is good to go now. He joins us on the phone. Forget the video thing. That's too complicated. Julian, I hope you can hear me now. I was asking about your base case scenario being more like Thanksgiving or even into the new year, which would have extreme ripple effects, not only an impact on the market, which I assume would be very negative, but also how the market perceives stimulus coming.
Yeah, so from our point of view, you've got sort of the twin concerns here politically. Obviously, the presidential race, which, again, could go days or perhaps weeks, but the one that looks like it's poised to perhaps go into Thanksgiving or maybe even further is the Senate. And in reality, given the fact that you're basically in the middle of a trading range that has still been, you had a bad October simply because not only the election uncertainty, but also the acceleration in the virus and this knowledge that we weren't going to get the stimulus prior to the election. If you have that uncertainty overhang, that's a recipe, in our view, for trading down perhaps to the 200-day moving average, at 3130 in the S&P 500. But ultimately, when you look at this series of circumstances, the fact that you're likely going to get substantial stimulus in almost all political configurations early next year bodes very, very well for the potential for a strong rebound once we get through the uncertainty.
So it doesn't matter to you when that stimulus comes, just knowing it comes is good enough. So, I mean, I guess what I'm getting at is if there is some sort of a blue wave, stimulus is not likely to be passed after this election. We'll be more likely to have to wait until sometime early next year. That doesn't matter in your view in terms of the economic recovery and the form and the shape and the trajectory of it?
Well, the importance of something like a blue wave or perhaps a configuration where the president wins re-election and you have the Democrats keep control of the House and take the Senate over, both of those imply that stimulus will likely be larger than the market looks at right now. I would say the base case is for early next year on the order of $2 trillion. That number is likely to be higher. And so if it's going to be higher, we think what that does is gives the market the ability to look through the fact that the virus accelerating is likely to dampen economic activity in the fourth quarter and the first quarter. But then you get this big dollop that, hopefully carries you through to the spring when the economy starts to open more normally and then you get medical advances as well.
All right. Julian, thanks so much for joining us. Thanks for bearing with us with those technical glitches. Julian Emanuel of BTIG. Here's a question, though. At what point does a market look past the immediacy and the promise of a huge stimulus package and start thinking about, Bonawyn, higher taxes, higher, tougher regulatory environment?
Listen, I think the market has been extremely myopic in terms of how it's been trading with momentum, with headlines, things around the pandemic. So it's hard for me to even consider looking that far out. Earnings aside and PE ratios that have been extrapolated from 21 numbers aside, this market is very much trading on economic fragility and pandemic fragility. And until we get through that, I really don't see the proposed tax changes, healthcare, and things of that nature really being factored in as heavily as they likely would be in another environment or scenario.
Shepard Smith here. Thanks for watching CNBC on YouTube.